Hi folks, Thomas here. Today I'm breaking down one of the most reliable, underused tools in a disciplined investor's income toolbox, the covered call. Whether you're managing a dividend portfolio, preparing for retirement, or just looking to enhance your growth strategy, covered calls can provide a steady and often overlooked stream of cash flow. I like to talk about picking up the low-hanging fruit of the stock market. That means finding the easiest, generally most ignored income opportunities the market has to offer. Covered calls are one of my favorite ways to find money and generate income that growth-focused investors never see. A lot of investors hear the word options and immediately think risky. But not all option strategies are built for speculation. One of the most conservative, income-focused strategies, and one used by top professionals, is selling covered calls. This is a strategy that's all about creating a secondary income stream from assets you're already holding. It turns otherwise passive, buy and hold investing into active cash generation. You're no longer waiting and hoping. You're setting up a plan that forces the market to pay you along the way. A covered call is when you sell a call option on a stock you already own. You're giving someone else the right to buy your shares at a set price by a certain date. In return, you pocket a premium, upfront cash in your account, no matter what happens. That premium is yours to keep and it's paid to you immediately. And here's the kicker. You don't have to do anything exotic. No margin, no advanced trading authorization beyond a basic options level. Most brokerages allow covered calls in standard IRAs. That's how conservative this strategy is. Most investors just hold a stock and wait. Covered call investors get paid while they wait. That's the core of my approach. Taking capital I've put into a stock and turning it into part of a powerful income-generating engine. And here's what most people miss. Covered calls aren't about betting on direction. They're about betting on time. Every day that passes, the premium decays, and that's a good thing for us. Time is literally money. In the Rebel income system, covered calls are the second gear in a three-step income machine. Step 1, sell a put and collect premium. If the stock gets assigned, no problem. You now own it. That's when step 2 kicks in. Sell covered calls and keep the cash flowing. This cycle, repeated consistently, builds a powerful flywheel of compounding income. It's like turning a single trade into a series of paychecks. And we're not doing this randomly. We're targeting quality stocks with strong fundamentals and cash flow. Ever wonder why we say writing a call? It's old school lingo from the days when contracts were literally written out by hand. It stuck. Today, when you sell a covered call, you're creating, virtually writing, through your broker, a new contract and getting paid for your trouble. Think of yourself not just as an investor, but as an income author crafting terms that put money in your account. This is a contract with defined terms. You know your strike price, you know the expiration, and you know your max gain up front. That transparency is powerful. It lets you be strategic, even surgical, about how you generate income. What happens if the stock rises past the strike? You may get called out. That just means you sell your shares at a profit if you've done it right and move on. Getting called out can be a good thing. It means you captured gains on the stock and collected a premium on top. The key is planning your strike price to align with your exit target. Too many investors worry about losing the stock. But if you structure your trades right, you'll be more than happy to sell at that price. It's not about holding forever. It's about monetizing value and moving on to the next opportunity. So why use covered calls? There are 3 reasons. First, income acceleration, premium plus potential capital gains. Second, downside protection. Every dollar of premium you collect is a cushion against losses. Third, consistent, reliable income the kind that builds confidence, cushions volatility, and compounds over time. It's like getting paid to wait and possibly paid again to sell. Let's say you buy a stock at $30. It's sitting at $40. You think it might stall there? Instead of selling right away, you sell a $42 call for $2. If the stock doesn't rise, you just made $200. If it does, you've still added extra profit to your exit. That $2 premium, that's a bonus return most investors leave on the table. Over time, those extra dollars start to matter. It's not about hitting home runs, it's about turning base hits into doubles and triples. That's what covered calls do. They stack the deck in your favor. Covered calls also cushion the blow when a stock drops. You keep the premium no matter what. If your $30 stock drops to $28 and you sold a $2 call, you're breaking even on the position. That buffer buys time, and time is a powerful ally for long-term investors. It's not foolproof protection, but it's measurable, repeatable, and reliable. When you pair covered calls with the right kind of business, ones with strong free cash flow and a history of resilience, that premium gives you breathing room. You're not reacting emotionally to every market swing. You've got a cash cushion to manage risk and preserve your ability to make good decisions unclouded by emotion. I regularly see covered calls delivering 2 to 5% per month. On solid dividend-paying stocks, that adds up fast. Imagine turning a 4% annual dividend into a 20% or more annual yield when combined with options premiums. Now, you're not just a shareholder, you're running a cash-producing machine. This is why I call it low-hanging fruit. It's sitting right there, ready to be picked. But most investors never reach for it because they're not trained to look at their portfolio as an income generator. If you're in growth mode, covered calls should still be part of your strategy. You can boost total return by writing calls at technical peaks. Repeated across many trades, this adds incremental gains, the kind that compound into serious wealth over time. Covered calls aren't just for retirees. They're for realists who want their capital to work harder. And here's the thing. This works in all kinds of markets. Whether sideways, choppy, or slightly bullish, covered calls provide a way to stay engaged, stay disciplined, and keep generating returns when others sit on the sidelines. That's the power of combining puts and calls. You generate income on the way in, selling the put, and on the way out, writing the call. Add in occasional capital gains and dividend payouts, and you've got a repeatable, disciplined system for compounding cash. This is dividend reinvestment on steroids. It's one of the only strategies where you can be wrong on direction, but still be right on income. And over time, that margin of error becomes a huge advantage. No matter what's happening in the market, discipline and cash flow will always be king. Covered calls let you stay defensive, yet productive. You're not chasing hype. You're collecting checks. And over time, that steady cash flow starts to separate the professionals from the crowd. Build it patiently, repeat it consistently, and you'll start seeing the results that others miss.
Thanks for your time. If you like this video, hit subscribe to get notified each time I upload a new video. You can also check out my Substack to get more real-world, income-focused investing insights every week. Thanks for watching. Stay patient. Stay paid.